We all know that real estate has created more millionaires than any other industry on the planet. We also know that it has created a lot of heartache due to mismanagement, overborrowing, and just simple life events that happen to all of us. Welcome to the Cash Flow Pro podcast. My name is Casey Brown, and I am your fearless leader. And although we might be bourbon sipping and at times foul-mouthed Southerners, we will always do our best to be honest, straightforward, and due diligent with all of the information we pass along to you. Welcome to the show. Hey there, and welcome to today's episode of the Cash Flow Pro podcast. I want to welcome you to our podcast as well as our channel for those of you that are watching on YouTube. But today I've got Taylor Sohns of LifeGoal Investments. Taylor, how are you today, sir?
Oh, I'm doing great. I'm super excited to be here. Thanks for having me, Casey.
No, we're the pleasure is all ours, and we're all ears when it comes to trying to learn and figure through some of these real estate concepts and ideas about investing and passive income and just all kinds of different stuff. As I think we were talking right before the show, you said you liked how we kind of go out and branch out and get some different subject matters for our audience so that we can we don't want to just bring the boring business stacks and capital structures and stuff like that. We want to talk about the real life things that create wealth, that create happiness, and create just life fulfillment, I guess, if you will. So tell us a little bit about how you got started. And I know that you and your brother both graduated with your MBAs, and I think you had said at one point both of you were on Wall Street. I don't recall if that was at the same time or different times, but nevertheless, it's obvious. It's going to be very obvious, very quick to my audience there that you know what you're talking about. So tell us a little bit about yourself, where you came from, and where you're headed.
Yeah, thanks so much for having me, Casey, again. So I grew up in the middle of nowhere in a one red light town in upstate New York, literally one red light, where nobody had any money, but everyone was just working hard to get by. And that's the roots that we came from. My brother and I both went to college and played football at a small college called Iona, which is just outside of New York City. So it was a drastic change of pace and the world that we lived in. We went from hillbilly New York, if you will, to almost major metro right on the outskirts of Manhattan. So very culturally different and a shock to the system.
That's it.
So that was cool. We had to acclimate quickly. And then after college, so my brother's a few years older than I am. So after college, he went right to work on Wall Street. And when I say Wall Street, he went to work for one of the largest asset managers in the world. So think about the people that build the portfolios of mutual funds, et cetera. And what he did there, and then what I subsequently started doing a few years later, is we would travel around the United States and we would work with literally the wealthiest families in the United States to build the perfect portfolio of stocks and bonds and real estate or whatever it might be. And he did it for 15 years, and I did it for 10 years. And at some point along the journey there, we both looked at each other and said, is this really what we're meant to be doing? And what we meant by that is Casey, we grew up, again, in a one red light town, and we said, these people that have 10, 15, $100 million, they're going to be okay. They're going to be okay. And they really aren't the ones that we feel need the real financial help that we could provide. And so eventually what we did was we stumbled across an idea that we said, you know what? Instead of building these one-off for these ultra rich families, why don't we just do this and place it in a format and in a vehicle that could be bought by anybody with any trading platform, be it Robinhood, Fidelity, Schwab, whatever it might be. And so at the end of the day, what our company's mission is to take the really educational foundation of financial planning and portfolio management, and instead of bringing it to the ultra wealthy, bring it to anybody, the mom and pop, and help them achieve their financial goals, because they have them just as much, if not more, than those families that have that uber wealth that we were working with.
That's right, man. What a good concept. And I mean, and it's almost to a degree. I know some traders are anti-crypto, but that's almost to some degree like tokenization. pretty close.
Yeah. Yeah, the democratization is something that's been thrown at us
Yeah,
a lot.
yeah, and that's so. I mean, that's an interesting concept, and one that sometimes can be tough to get the mind wrapped around. But one thing I want to, it's almost as hard to get my mind wrapped around there being anywhere in New York where there's one light, because I just don't picture New York like that. I guess that's just not so.
There are maps of New York that are like funny candid maps of like T-shirts and stuff that have a line drawn of downstate and upstate, and I've lived in both, and the two of them are dramatically different. You see pictures of rolling mountains and forests in upstate New York, and then you see the gridlock of inner city Manhattan
Yeah,
in the other.
my gosh, I tell you, that's an unbelievable difference. It's hard to imagine. So anyhow, but all right. So now you're bringing this vehicle to. I want to dive just a little bit further into what this vehicle, what it looks like, and again, the proverbial vehicle, if you will. What does this investment vehicle look like, and what goes into it, and then what comes out of it the other side?
Yeah. So I'll give you the idea that kind of was the epiphany of, okay, we knew we weren't meant to be working with the ultra wealthy at the end of the day. And we knew we were meant to bring a solution that could be accessed by anybody. But it was always how do we do it? How do you access it? Et cetera, et cetera. And the epiphany happened for my brother, actually. And where we felt there was a gap in the market wasn't realized until he stumbled across this in his real life. So my brother lives in a condo in downtown Saratoga Springs, where we live now. We don't live in that one red light town anymore, but we live in a modest city, a pretty small city. But he lives in a condo, and he's got a wife, and at the time had a daughter on the way. And they were living in 1,200 square feet in, a third story walk up, et cetera. So it was a situation that wasn't ideal for raising a kid, if you will. So this is right as COVID starts to hit. And they start looking at each other and saying, hey, we're going to need to buy a house or build a house, whatever it might be, here in the coming future. So let's start to look around. And they had some money set aside, and they had money set aside in a savings account. And so, Casey, do you know what a savings account yields right now?
I mean, you might buy like a bag of lollipops at the end of the year or something like that. $1 million.
If you've got a lot of money in it.
Here's your bag of gum, or I know. Yeah.
Yeah. So the average, I'll throw a funny statistic at you. The average savings account yields 0.05%. And so how long does it take your money to double in that account?
Well, I mean, the dinosaurs.
1,440 years. So anyway, at the end of the day, as people save for a home down payment, most people sit in a savings account in order to save that money because they deem that as safe. Well, what happens when you start to see home prices run away? So COVID hits, people start to move into the suburbs, et cetera. We know all of a sudden home prices take off. And so he sees them going up at 5, 10, 15. And now if you look at a rolling 12-month period, home prices are up 19.2% year over year. Ouch. So if you're sitting in a savings account, you've lost 20% purchasing power over the past 12 months. And so he and I have the financial background. That's what we have our undergrad and grad degrees in. And then we have several certificates that come to portfolio management and actually building out portfolios. And he looked at me and said, first of all, there's got to be something online. There's got to be a mutual fund or exchange traded fund, which is a very comparable vehicle to a mutual fund. There's got to be something out there. And we looked around and we literally found nothing. And so he and I put our heads together and we said, well, we can build this for you. So we put together a portfolio that involves stocks, bonds, commodities, a diversified basket that's specifically tilted towards hedging home price increases. And what we did was we put it together for him, and then we looked at each other and we were like, we're not the only millennials in the world right now that are looking to buy a home. Millennials are coming into peak home buying ages right now. And so you have this massive demand based on millennials. And then Casey, the supply of homes in the United States right now is down, way down since post 2008, right? Because we couldn't build, no one would lend, et cetera, et cetera. So it doesn't look like home prices are coming down in any meaningful degree anytime soon. So there's going to be need for a vehicle like this that helps people pace home price inflation rather than just sitting in a savings account. And so that's when we built out what we call our LifeGoal Home Down Payment Investment ETF. And so let me just kind of take a breather there and hear what you have question-wise,
So
whatever.
Again, let's go back and give the listeners a definition of ETF, exchange traded fund, just so that we have a solid base to start with, and then we'll go up from there.
Sure. So a mutual fund is historically what people are accustomed to and used to utilizing. And that's just, you can put a basket together of stocks, bonds, etc., and you and I can all pool.
Understand the concept. I mean, they know, they're like, oh, well, so and so said to buy a mutual fund. They don't understand the concept of
So the concept of a mutual fund is, me and you, Casey, we put together our money, and then a professional will go out and buy XYZ stock and bond for us, and put together a portfolio of a lot of underlying stocks and bonds. And that way you're diversified and you have a professional manager that's watching over it for you. Now, an ETF, without getting into detail, is the new age mutual fund. It's a modernized version of a mutual fund. And what it does is it allows trading on these major platforms without a commission, and you can trade it at any time throughout the day. So you could buy and sell it any time throughout the day versus a mutual fund that only trades at the end of the day. And then the biggest advantage of an exchange traded fund versus a mutual fund, and this would take getting into the weeds to talk about the details, is there are massive tax advantages of an exchange traded fund over a mutual fund. And you don't have to believe me that an exchange traded fund is a superior vehicle. All you have to do is look at the data. Every single year for the past decade, mutual funds are in net outflows. So they lose money every single year, and ETFs are in net inflows every single year, because it's simply a better vehicle. And what you see now is there aren't any, almost an exclusive nature, there aren't any mutual funds being brought to market, yet new ETFs come to market every day because it's a superior vehicle.
Now, what is the difference in an ETF and what, and I've mentioned Warren Buffett on this show all the time, mostly because obviously, you know, when we're a fund of funds like I am, as far as real estate investing goes, we try to vet managers, vet property managers and vet managers and people like that. So what's the difference in an ETF or even a mutual fund for that matter, in what Warren Buffett does, you know, where he kind of, you know, he takes in he sells actually a share back of Berkshire in exchange for money, and then takes that money and goes and buys whatever it is. So what's the difference there?
So it's a very similar structure to what an ETF is. The difference between that, now Berkshire is unique in the fact that is publicly traded. But there are a lot of scenarios where people are privatizing capital, bringing it together and buying things, and you would need to know them in order to get involved, whatever it might be. You're familiar with that, obviously, Casey. Yep. So our product, our ETF, trades on the New York Stock Exchange. So you could go on to Robinhood, Charles Schwab, whatever it might be, and purchase it there, along with any other ETF that is out there. It's regulated by the SEC, the Securities and Exchange Commission, which is something that's really important to give you some comfort as to, there's oversight here, and people aren't just out there shooting from the hip and being cowboys.
Now, the one point you made there a little while ago, when we were right after we kind of determined what they were, you said they are used to, you specifically tied it to down payments, home down payments. What's the correlation there, and what does that look like?
Yeah, so really good question. So there's two goals in what we do with this LifeGoal Home Down Payment ETF. The first one is, we know that if you're having this money set aside for a home down payment, you don't want it to be all that volatile. The volatility and the downside capture has to be in the forefront of the manager's mind at all time. And it absolutely is. Because again, we know most people are taking this money from a savings account and moving it into this product again, because you know that in a savings account, inflation is going to beat you up. So the first and foremost goal is control the volatility and control the downside. But Casey, to your question, how do you actually gear this towards a home down payment, and what's unique about it versus some of the other things out there that you could buy? It's the fact that a portion of the investment, call it about 15% of the overall allocation, are in stocks that are specifically tied to home prices. So if you're using this to hedge the increase in home prices that we're seeing in the United States, why not have exposure to things like Home Depot, Lowe's, Stanley Black & Decker, Trek Deck, home builders, all of these that have direct correlation with increasing home prices. If homes continue to be demanded, which is driving up prices, you can bet your butt that you're going to see continued demand for 2x4s and hammers sold at Home Depot over time. Now, it's not to say that on a day-to-day basis they correlate perfectly, but over time the direction is very consistent.
You're looking at a mean. I mean, everything always comes back to the mean, and now I assume so that's 15%, and I assume a good portion of what's left is probably actually dedicated to the actual 2x4 commodity itself. Potentially even you could get derivatives way down into the oil it takes to kiln dry the 2x. I mean, you could do all of that and stretch it across and even glue it together with some options as well. Am I right? I mean, is that kind of what takes up the other part of it?
Yeah. Directionally, you're very right. So I'll take it from a high level because I talk about this a lot, and this is kind of the mechanism I do to talk about it. But so about 70%. So this is, let's wipe the slate clean. I'll tell you the entire allocation. About 70% of the portfolio is actually in bonds.
Okay.
The reason it's in bonds is because, again, they control the volatility and the downside. Think about bonds as being pretty darn boring. And again, we know that the volatility can't be all that high because people need this. When that house pops on the market, they need to be able to sell it and buy that house. So they can't have a ton of fluctuation. So 70% is in bonds. And then there's about 5 to 10% in commodities. So Casey, to your point right there, the underlying commodities and things that it takes to build out a home, et cetera. The nice thing about commodities is just in general in an inflationary environment, this isn't necessarily to houses in general, but they hedge inflation really well. And obviously we see massive inflation in the market right now. CPI printed this morning at 8.5%.
Oh my gosh.
And then the remainder of it falls in the stock allocation that we spoke about there, half to 2/3 of which are directly tied to housing related.
Now, are the bond portions of that is the thought process there tied to interest rates because they have an inverse relationship? Is that, or if bond prices go down, then you can make money on the trade there? Is that the thought process there, or am I way off?
Yep. So the bond allocation in general is more of the stability, more of the anchor is what that's thought of for. And all bonds, to your point, Casey, all bonds aren't created equal. So you look at 70% of the portfolios in bonds, half of that bond exposure is high quality stuff. So think about things like treasuries guaranteed by the US government, municipalities that are backed by revenue, projects within a municipal, et cetera. Those are, to your point, Casey, interest rate sensitive. On the other hand, the other portion of the bond allocation is lower quality bond allocation. So think of things there like emerging market debt and high yield. That stuff is going to be less interest rate sensitive. And at the end of the day, what we always try to do is we talk a lot about the portfolio construction. We spend a ton of time, Casey, working on portfolio construction. It's what we do all day.
That's your
don't put me in the weeds down there because I could spend days in there searching around. But at the end of the day, what we're trying to do is deliver the product that meets the goal. The goal, again, is twofold: low volatility and downside, and hedge home price inflation. That's quite simply all it is. And then one more attribute I'll say, and then I'll shut up on it, is it also has a significant yield component. So again, right now savings accounts yield 0.05%.
40 years,
Thank you. So, right, 1,440 years. You listen well. And at the end of the day, our product right now yields 2.96%, and it's paid out monthly.
Wow.
So, what we're trying to track down, Casey, is that, again, right now home price inflation is at 19.2, is crazy high. And no product anyone builds is ever going to keep track with that. But what we're trying to target is over the long term, in the last 50 years in the United States, home prices have gone up at 5.5% per year. And so that's kind of what we're trying to back into.
Yeah, you come down and you're only left with a 2-point-something% exposure, and that's at a mean, not taking into account the the peaks and valleys in between, especially if you can sell and make more at one point or another. So it's I tend to get really deep into discussions like this. So I'm trying to, like you said, I'm trying to stay above the weeds so that I don't get lost, because like I said, I have a very derivative mindset when it comes to just niching everything down. And like I said, we used to feed cattle on paper. You would just buy and sell and hedge and then pork
Sure.
bellies and that kind of stuff. So tell us now. Again, we're getting into some of this stuff. I'm assuming you all are licensed, and is that the regulatory stuff that goes along with this? I mean, is the symbol something you can share? We want to
Yeah.
we want to definitely lead people to a path of saying, hey, these guys are legit. They know what they're talking about. Obviously, I wouldn't have had you on my show if that wasn't the case. And I know that at the end of the day, the consumer's best interest, the consumer being the potential home buyer at some point, you have their best interest in mind. And obviously, for folks that don't really understand how to diversify, and for one, let's back up, and I'll speak on this because I know specifically about the commodity side of it. But the individual investor can't. They can go buy a Home Depot stock, they can go buy Lowe's, but you can't just walk up and say, hey, I want to buy one contract of lumber. You buy I forget how they section it off now, but that's the kind of stuff. And that the average consumer can't just go trade in and then all of a sudden now they're hedged up and ready to go. So you all bringing a vehicle like that to the market has got to be somewhat, I mean, that's specifically derived to people that have been saving money. I mean, that's got to really be big. I mean, I'm sure you all have had a lot of people that have just, I mean, I'm assuming just thanked you for that.
It's been very humbling because, again, this all came from a problem, again, a real life problem my brother sat in, and there was no product to meet his needs. And the thing when it comes to Casey, to your point, even if someone has the ability to go buy those underlying commodities themselves, that's still not the right exposure because they are incredibly volatile.
God.
And so like for context, like a lot of people have said, hey, why don't you just buy home builders? Like that's a perfect correlation, a perfect hedge. Home builders right now, year to date, are down 35%. You don't want that exposure, right? That's why you need that bond as that dampener on the other side.
Well, and everybody always, again, I'm holding my head above out of the weeds here, but you always get into the thought of margin calls and stuff like that, which I've been on the wrong side of those at a time or two, and it's not fun. It's not fun. So
yeah.
Hi, this is Casey Brown, host of the Cash Flow Pro podcast and YouTube channel. Have you been thinking about investing in real estate but just don't know where to begin? I'd like to help by inviting you to check out our website at www.3000capital.com. There you will find an array of material that will help you learn all about real estate syndication. And while you're there, be sure to check out our free video series download titled 5 Must-Know Keys to Success in Passive Real Estate Investing. I'd also like to personally thank you for making Cash Flow Pro part of your day. Now, back to the show.
So what is the symbol? And again, I think sometimes it's difficult for consumer investors or even people that are saving for down payment. People that we would consider to be home buyers at some point in the next, say, 5 years. Mm-hmm. I think it's very difficult for us to correlate an actual human like yourself on the other side of a stock ticker symbol. Right. And so what's the process? And again, if somebody wants to learn more, obviously we want to give them whatever resources you have available so that they can get in touch with you or your company and go from there. So let's talk a little bit more about that.
Yeah. So, one of the things we do at nauseum, in some people's opinion, is we put out a lot of content on. So we have this. So the ticker, to your point, Casey, before I get away from that, the ticker is HOM, like home without the E. HOM. It's pretty easy, and easy to remember because of that. But we put out a ton of content on LinkedIn, on Instagram, on Facebook, etc., and then on our website as well. So the daily stuff comes on all the social media platforms, and that's at LifeGoal Investments, at LifeGoal Investments. And then each one of our funds, so we've spoken about one of our funds here, Casey. We have 3 in total. Each one of them has a video on our website that breaks it down to very simple, digestible terms in a 1-minute video describing exactly what it's meant to do. And our website is lifegoalinvestments.com. And one more thing I'll say, Casey, is like, what I think falls on deaf ears when it comes to these Wall Street firms is that investing is really, really hard for the end consumer. It's really hard. It's a world and a jungle that they don't understand like a foreign language. And Wall Street seems to build products that are meant to have a financial advisor then digest and create a portfolio for someone. But at the end of the day, about 95% of the population doesn't have enough assets that warrant a financial advisor's time.
Right.
And so that's just how the revenue model works. So think about this, Casey. 96.7% of ETFs and mutual funds are exclusively 100% stocks or 100% bonds.
But nothing that has
so you're one or the other. Yet very, very, very few investors have a need that falls into one of those 2 camps exclusively. So all of a sudden it becomes incumbent upon them to put together bits and pieces of each one of these. And we said, like, hold on, time out. If you buy a car, Casey, you get all the parts individually, and the car manufacturer says, good luck, Casey, put it together. Right? That's ridiculous. But that's exactly what Wall Street is asking folks to do. They put these confusing names. They make them all in their individual silos and say, put it together. We just said, hey, let's make an easy button for people. And how you do that is an ETF that's a multi-asset ETF. So like the home one is specific to someone that's purchasing a home. But we have 2 more. One being the LifeGoal Wealth Builder. And that's Wealth Builder is just, hey, you want to build wealth towards retirement or whatever it might be, and you want to have a ride that's not incredibly volatile like buying an individual stock, so you actually stay in the seat and let compound returns and interest take place. We'll build that for you in one single ticker. You can go in and type in WLTH and get your bond, stock exposure, etc. And the goal of it, is long-term wealth creation. Why do you know that? Because you looked at our website at a 1-minute video and we told you exactly what we're trying to do there.
And just for further qualification, if people aren't convinced already, what's the third one? And then what's the breakdown of the wealth as far as like, is it stocks, half, I mean, what is that?
Yep. Really good question. Yeah. So because Wealth Builder is a longer term project, you're going to have a lot more stock exposure because over time you want to take on more risk. The longer time frame you have, the higher risk you want to take on, because risk at the end of the day leads to a higher reward. But you need time to let it play out because risk also means more meaningful downside in the short term. So again, stay out of the weeds here. So anyway, that's not you, that's me.
Get out of here. I know, man.
So no, that portfolio is about 70% stocks, about 5 to 10% commodities, and then the remaining quarter-ish of it are going to be in bonds. So it's the more boring stuff.
It's almost opposite of the other, which, like you said,
exactly right. Because again, you have that
that's
goal.
Right. You're carrying your risk out further, more years, and then you go from there. So, and what's the third one?
Yep. The third one ticker is SAVN, SAVN. Okay. So you can, I see your head nodding like, okay, I kind of get the drift here as to what we're looking for here. That is going to be a portfolio that is someone that's looking to be very conservative, but yet do better than that 0.05% at the bank. And so the asset allocation like that is going to be very different than Wealth Builder because it's going to be a lot more conservative at the end of the day. It's going to be about 75% bonds, 5% commodities, and the remainder in stocks. And here's a cool thing that is a little bit nerdy, Casey. So, but let me bring this to you anyway. So if you have 100% stocks, that's high risk, high reward. 100% bonds is low risk, low reward. But the interesting thing is, if you take a 100% bond portfolio and you put a little bit of stock exposure in it, you actually can reduce the risk. you take the risk and you bring it down further than just buying 100% bonds.
I thought.
So again, stocks are high risk,
Yep.
high reward. Bonds are low risk, low reward. But if you add a little stock exposure into a bond portfolio, it brings the risk down from bonds relative to just owning 100% bonds.
Wow.
And so that's what we do. The asset allocation that is the lowest volatility combination of stocks and bonds is about a 75% bond, 25% stock mix. And so when you think about it, that's exactly where we sit with that save-in product. Is, again, you actually get a lower risk profile and a higher return profile than just owning 100% bonds.
That's yeah. I mean, I it's even in the weeds for me. I mean, I'm trying to dig my way out, but no, listen. Hey, I want to just real quick. I want to go through those stock symbols. One is SAVN. One is HOM, which is specifically geared towards people that are just savings for down payments and so on, where your money is in something that's anti-inflationary or grows with inflation. And then the third one, I didn't get it written down, but I know it started with a W.
Yeah, my bad. That's wealth, and that's just no vowels. Wealth. WLTH.
Okay, so we've got SAVN, WLTH, and HOM, and those are Taylor and LifeGoal Investments, 3 ticker symbols for obviously everything in life. I mean, and that's the thing is people can churn out. You put your money into something like that, and it's been like my life goal as LifeGoal Investments to tell people that you can't look at things from a capital perspective. You have to look at things from the cash flow perspective. If you're like, man, where are you going to find $500,000 to go buy this income producing asset? Well, if it produces enough income, all you got to do is find a banker and they're going to loan. But what I'm getting at is people look at the debt, they look at the capital. That's all they think is debt, capital. And of course, then you get into Robert Kiyosaki and moving forward and saying, hey, let's put my capital here, and then live off of the yield, if you will, which everybody does that. It just takes some people that make retirement age and have worked the 9 to 5 throughout their whole year. They do that just on a longer timeline, I guess. And what we're trying to do is shorten that timeline and say, hey, invest in this, capital money here, live off of this. So anyway, all right.
Yeah. It's not all that different of a game that you and I are playing. It's just a different asset class.
That's right. So, well, listen, Taylor, thank you so much for your time, and I hope that the listeners aren't too lost in the weeds. And I know that I've thoroughly enjoyed our conversation, and it kind of hit on several of the high points that I know are questions out there, especially like you said in the millennials' minds of maybe what can I do? My gosh, I can't find a house. I've got my money saved up, and I'm just they're like, inflation is, I've lost 20% in the last however long. So I can't thank you enough for sharing your knowledge and what you all have to offer. Now, before we jump off here though, I want to leave the listeners with a way to reach out to you. I don't know. I know that this can be a little bit encumbering if everybody runs to you at one time and says, hey, I want to do this, but I want people to be able to reach out to you if they want some more information or want to learn further. I know we've got LifeGoalInvestments.com. Is there any other way somebody can reach out to you, or is that pretty much the way you want?
Yeah. The most direct way to reach out to us is just via email. And then if a phone call is necessary, we can set up a phone call from there. But our email is info@lifegoalinvestments.com. Pretty simple. info@lifegoalinvestments.com. And we're happy to have these conversations because we know, again, investing is not the easiest game in the world. And we want it to again, we're just trying to simplify.
Man, I knew when I heard I wanted you on this show because I wanted to just kind of bring a little bit of this spice of real world stuff that goes on, even though we're all looking at investments and yields and deals and this and that there is a level of people that are still, trying to find their way through some of these inflationary times. So anyway, thank you so much again, Taylor. I can't thank you enough. Listeners, reach out to Taylor at lifegoalinvestments.com, or it's info@lifegoalinvestments.com, and check out his ticker symbols. And I think people can just go to their Ameritrade account or whatever and pull that up and see the charts and all that.
And anywhere you can trade a stock, you can trade any one of these underlying
Taylor, thanks again, sir. I hope everybody has a wonderful day, and thank you so much for your time.
Cashflow Pro is hosted by Casey Brown, founder and CEO of 3000 Capital, a commercial real estate investment firm committed to providing its investors with ongoing cash flow and helping them build long-term wealth. If you enjoyed today's podcast, make sure to hit that subscribe button so you'll be notified about all our future episodes. You can find more information about us and our investment philosophy by clicking the link in the show notes below. Thanks for listening.